2024 was an incredibly poor year for Intel, down more than 50%, losing in fact more than half their market cap. We also got to see the CEO Pat Gelsinger supposedly ousted by the board after his very poor performance, and they also talked about plans to do some massive cost reductions, which include cutting around 15,000 jobs, and it didn't just stop there. They were looking to do more than 10 billion into 2025, both in the research and development as well as other areas in the business. We also saw them replace in the Dow Jones by Nvidia, and if we just take a look at the performance last year, Intel, as you can see in the dark red, the worst performing. In fact, if you had picked pretty much any other semiconductor company, you would have done significantly better. Now, there is some bullish catalyst for this company moving into 2025, as we did in fact see there was the finalization of their funding under the CHIPS Act award. That should help them, especially with Donald Trump, who does want to bring a lot of manufacturing, particularly semiconductors, into the US, something that we have in fact seen with Taiwan Semiconductors with their new factory in Arizona, and they also had some fairly decent earnings in their latest quarter. As we can see, they did in fact increase their guidance, and if we look to see how they performed, well, they outperformed at 17 cents with the market anticipating an actual loss of 2 cents, and their revenue also came in under at 13.3 billion versus 13.02. Even if we take a closer look at the numbers, when you do compare it to the same quarter, not actually looking great. Down 6% year on year, gross margin down as well, and their earnings per share, well, not looking too positive at all. So there are some considerations for this company that we do need to have. Their revenue does move in the wrong direction. We want companies increasing their top line as well as their gross margin, which, as we can see in 2024, Q3 was 18%. The same quarter last year, it was sitting at 48.8%. So there is quite a lot to consider with Intel, and their outlook also for the next quarter, which will be reported at the end of this month, is also in anticipation, expecting the revenue to be down, the margin as well as the earnings per share. Now, if we just take a quick look at the company, not only are they down pretty much more than 50% over the last year, but if you've been a longer term shareholder, again, no real good news, negative 44%. So if you're someone that invested, say, $10,000 10 years ago today, right now you would be sitting with less than half of that amount. Definitely not something we want to think about when we look to the next 10 years. So let's take a look today. Is this a company that we can see rebound into 2025 and beyond? Should we be looking at this as a turnaround play? And right now it is trading towards their 52-week low. We get a triple hold right across the board, and as we will come to show you in terms of their earnings, well, based on the full EPS for this year, 98 cents, the forward P is anticipated to be around 21. Now, if we look back in terms of their earnings and their results, they have a 50% track record, so whether or not you do have faith that they can hit this forecast, something to consider. And in terms of moving forwards, there is a lot of inconsistency, some negative quarters as well as some that are positive. In terms of the underlying metrics of the company, well, as always, with free cash flow, we do want companies that have consistent numbers moving up over the longer term. With Intel, we do see it not only negative over the last 2 years, negative on a trailing 12 month, but also anticipated to be negative over the next 12. So definitely something to keep in consideration. In terms of sales growth, as always, we want a minimum of 3 to 4% just to keep up in line with inflation. With Intel, very inconsistent year on year. In fact, the last 2 years were back-to-back double-digit decreases to their top line, although we do anticipate, based on the trailing 12 month, that the full year of 2024 may come in around inflation. But realistically, when we do take a look at the top line on the numerical format, that is quite poor, considering 54 billion that they reported in 2023 is less than what they reported 10 years ago in 2014. Again, just a lot of things to consider. Then we're looking at the shares outstanding. As always, we want to identify companies that return excess cash through share buybacks, something this company has done all the way until 2021. They actually did it quite aggressively. They bought back 1 billion of shares during this period. What they've now done since then over the last few years is diluted your position. However, what we do typically say on the channel, if companies are diluting your position but are massively outperforming the S&P, you probably wouldn't care as much. But as we did see earlier, this company not only massively underperforming, but actually has been negative over the last year and over the last 10. In terms of ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital, something that we can see right now, very strong up until 2021. The last 2 years very poor, and negative 1% on a trailing 12 month is a little bit of a red flag indicator. Again, we see these same issues over the last few years because ultimately the operating margin as well as the free cash flow margin have actually been pretty strong up until 2021. We actually get to see some very good numbers well above the minimum 16% we want to identify and the free cash flow above the 5%, although the last 2 years as well as the trailing 12 month isn't looking that positive. Doesn't mean it shouldn't be investable. Always we've got to question whether or not we can see this company turning around over the longer term, and maybe the market has potentially overreacted, something we need to consider. And then we look at the net debt to EBITDA. Now this correlates to the balance sheet strength. One thing we didn't actually cover earlier on, but they did in fact stop their dividend in 2024, which in all honesty probably helps this company given that we can see this getting a little bit too high. 1.5 the maximum we want to see, 2.26 on a trailing 12 month. It is nice to note though over the next 12 months it is anticipated to come down, and we would expect this trend to continue given the massive cost reduction they are doing in the overall business as well as the workforce. Now we also want to let you know we have released our latest free weekly article, which we drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So sign up, click below, you can read these straight away, next copy coming tomorrow morning, and you can also grab a copy of 46 undervalued stocks for the month of January. Lots of information for each one, the upside that Wall Street themselves see over the next year, and in fact you can grab a copy of 29 stocks that Wall Street themselves believe right now have the most upside in the S&P. So click below, you can sign up and start reading straight away. In terms of insider ownership, well, very low at 0.04%. We see around 650,000 worth of selling over the last year, with a little bit more buying. This is during the same time frame. And if we take a look in Q1 of 2025, no buying, no selling. In Q4 we got the sale, and in Q3 we did get the buying. Now you could argue all of this data pretty much right now is outdated, and as we can see, the most recent sale was in fact on the 7th of November. EVP around 25,000 shares, netting them 650,000. But as we always say with sales as well, there isn't typically a bearish signal. Management sell for many reasons, personal and financial. Information is there though if you want to incorporate it into your own analysis. Institutional aspect, 65%, 7 billion worth of sales over the last year. A little bit more buying, in fact 12.8 billion, so pretty much nearly double during the same time period again. A lot more selling in Q4, actually 1.1 million with only 167,000 buys, and that trend is the same as the previous quarter. So yes, over the last year, institutions have been buying a lot more than they have been selling, but over the most recent 2 quarters, we have actually seen the opposite. Regardless whether they buy more or sell more, always do your own due diligence. In terms of their income statement, well, we already covered the inconsistency of the top line. In fact, they reported a larger revenue number in 2014 at 56 billion than the 54 from December 2023. But what we ideally want to highlight, what is the story that we can see from the bottom line net income? And actually, not only very inconsistent, but very poor as well. It was 12 billion in 2014, 1.7 billion in 2023. So there are a lot of red flags that are coming up with this company. But again, always do your own due diligence, always have your own investment thesis, and we will shortly come to our own valuation as well. In terms of a quick health check, total cash versus total debt, 14.4 billion in 2014, 24 billion in the latest quarter. And as always, we compare this to their total debt, as one number in isolation doesn't tell us anything. So their total debt, as we can see here, both numerically and directionally, has increased quite rapidly from 14 billion in 2014 to 50.2. And as we did say earlier, net debt to EBITDA a little bit higher than what we want to see for the semi space at around 1.5. Then we have a very quick look at the cash flow, where we do want to highlight the cash this company generates from operations. Now 20.4 billion in 2014, 11.5 in 2023, and based on the trailing 12 month at 9.7, we do anticipate this to be lower than the previous years. So a lot of metrics are moving in essence in the wrong direction, not really where we want this to go. And in terms of the valuation itself, Now they do get a D+ in terms of the gradings. The P on a forward-looking basis should actually be around 21, the sector median at 25, so in this aspect it is actually trading at a discount to the overall sector, and that is something you can see in the other valuation metrics. Whether you use the price to sales, price to book, this company is trading at a discount. You could argue it deserves a discount because of the poor metrics that we have seen so far, or in fact maybe you believe the market has overreacted. Now growth gets an F, therefore maybe we should come to believe that it does deserve a discount. Revenue year on year 3% below the 4.5 of the sector median. Forward looking -4, sector at 5.6, and the other thing we draw your attention to, where they actually look pretty decent, 25% expected earnings per share growth over the next 3 to 5 years, much better than the sector comparative at 15.5. We then draw your attention to the profitability, where they get an A. Now gross margin 40%, sector comparative at 51. Bottom line -30%, not great at all, sector at 3.84. One thing though that does look promising is the cash the company generates from operations, just under 10 billion, with the sector comparative at 97 million. Now a quick reflection on this part of the analysis: triple hold from all three analysts, D+ on valuation, F on growth, with an A on profitability. Two more things before we jump into our own valuation process. Firstly, comparing their performance against other semis in this space of a relatively similar size. Total return, so including dividends reinvested, which they were paying just up until the end of 2024. Intel -27%, the worst performing by quite some margin, but as always, past performance is not a determinant of the future, just something that we like to add into the analysis. And the S&P, well, over the last year, no surprises, massive underperformance, and over the last 5 and over the last 10, we can see that similar conclusion. And as always, we just incorporate this so you can think about whether or not you want to incorporate into your own portfolio either a semiconductor ETF or one that tracks the S&P. Now jumping into the valuation, our DCF calculation comes to $27. Now we got this by getting the free cash flow year on year. Average growth -14%, although you can see fairly skewed going from negative to positive a few number of years. Now forward looking, we've been very conservative. We've gone for 0%, and we have also used free cash flow of around 9 billion, something we saw at their lowest point over the last 10 years. Now based on that, with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, $27, which actually indicates 31% upside. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Intel or any others, but we'll show you full transparency for those that believe 4% to be correct, $36 indicating 77% upside, and at 8%, $48, which actually indicates more than a double right now at 136. Now today's episode, we want to be very conservative given the free cash flow numbers are quite subjective, so we have gone for 0%, which we will apply a margin of safety of 10%. Execute on that though only if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now if you believe that in today's episode, a buy at around $24, then we keep going till it's near the current trading price, and what we can see in today's episode, you're getting near 25% MOS, with Wall Street themselves indicating 19% upside over the next year. Their price target sits at $24.53. Now, as we did talk about earlier on, Intel has faced significant challenges in recent years, including their decline in their market share, their leadership changes, as well as the CEO that did in fact retire abruptly, and they did leave the company without naming a successor and raising concerns about the overall strategic direction. So the leadership vacuum itself has contributed to the near 60% decline in their stock over the last year, and analysts themselves are in fact divided on their prospects for 2025. We have some that express skepticism about the company's ability to execute a successful turnaround, advising caution to potential investors. Others though do note that because this company does trade at around a 25 times their 2025 earnings, it does give us a reasonable valuation for the company if they can address those challenges. However, given the current uncertainties surrounding their leadership and strategic direction, investing in Intel still carries quite some notable risk, and the investors should closely monitor the appointment of a new CEO, any strategic shifts that may follow, and in all honesty, until clearer signs of a successful turnaround emerge, it may be prudent to really approach this company with a lot of caution. As always, do give us your thoughts below. 25% MOS with nearly 19% upside. Is this one you are looking to buy? Maybe hold, or for whatever reason doesn't fit your portfolio. Don't forget to sign up to the free weekly newsletter. We are dropping the next copy tomorrow morning. Grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. And as always, have a great day. We'll see you on the next one.